It's time for our year-end review and predictions show. Ted is here to review our predictions from last year, and we'll give you our predictions for 2023 starting right now.
This is Debt Free in 30. Here's your host, Doug Hoyes.
Ted, welcome back. You are in Guelph today as opposed to in your normal chair here. So this is, I think, the first time in 9 years you've appeared on the podcast by video as opposed to being in the studio. So this is a show that we have to record as close to the air date as possible because we want to make sure we're using the data as currently as possible. So sadly, we were not both be able to be in the same studio at the same time. So here we go. Year-end review show, predictions for 2023. Why do you and I do this episode? Well, ego. We have big egos. That's the main reason. But it's also because we want to know what's going to happen so we can decide what to do with our business, Hoyes, Michalos and Associates. Are we going to be busy or not or what? Now, for the listener, everything we discuss will have an impact on their financial life as well. That's why I think you should be interested in it. You know, should I ask for a raise at work or should I be looking for a second job? Should I buy a house? Should I rent? What's going to happen with the economy in 2023? Now, I strongly believe that if you can't predict the future, you don't really understand what's going on, and therefore people should not be listening to your advice. Of course, we'll see how.
Write that note when you check to see how we did last year.
We'll see how our predictions. And of course, obviously, nobody can perfectly predict the future. Right. Otherwise, we'd all pick the right stocks and we'd all be billionaires. But I think you should be able to describe your thought process and show your work, which is what we're going to do today. So whether you agree or not with our predictions, how did we come to them? Do you agree with our thought process? If not, well, then obviously our predictions are probably going to be wrong as well. Now, last year, you remember, good old show number 383, we made some predictions. So let's start by seeing how we did. Let's see if the listeners should waste their time listening to the show this year. So last year, we both, and I'll put a link in the show notes on YouTube to everything we talk about, but also to last year's show. So we've got a ton of graphs and charts and everything. So this would be a good show to watch on YouTube so you can follow along, but we'll explain everything if you're listening to the audio version. So last year, we both admitted that our confidence level for these predictions was pretty low. That's
right. Between the pandemic and everything else that was going on in the world, we weren't very confident about what was going to happen.
Exactly. A lot of volatility in it, but we tried anyway. So let's play some clips from last year's show and see how we did. So first clip, we discussed what we thought would happen with inflation. So here's the clip. So you think that if we're doing this podcast a year from now, that
inflation will be high. In fact, probably higher than it is right now.
There you go. So Ted's prediction, inflation higher, and right now it's 4.7%. So you're thinking like 5% or something like that.
And inflation doesn't have to scare people as long as you've got income that's indexed to inflation. The problem is all these people get left behind, and costs always go up before income.
Right.
So your expenses are going to increase before you see any more money in your pocket.
Well, Ted, you nailed it. The most recent inflation numbers for Canada, the Consumer Price Index rose 6.9% year over year in October, matching the increase in September. In October 2021, which was the month we were, the most recent stats when we recorded last year's show, the inflation rate was 4.7%. In October 22, as I just said, 6.9%. So, Ted, you were definitely correct. The inflation rate was higher. And in fact, it was even higher than the 5% you thought it would be. So that's a win for Ted.
Okay.
Now, how about me? Well, I was of the view that a lot of people left the workforce during the lockdowns, which they did, and they weren't coming back. And I was right about that. The labor force participation rate has fallen. I thought that with the end of CERB and CRB and all of the other subsidies that government spending would ease off. I was correct about that too. And I thought it would therefore lead to lower inflation. Well, let's play the clip. So that's why I think deflation is the bigger issue a year from now. So a year from now, you're saying it'll be around 5%. I think we're looking at 2% or less. So when we come back, we'll see. Well, I was clearly wrong. Inflation is not 2% or less. It is 6.9%. So I was wrong. Now, in my own defense, here's my excuse. This is the excuse part of the show. I didn't predict the war in Ukraine, which of course led to many issues in the world economy. I did not predict the continuing supply chain issues.
Right.
Probably should have seen that coming, but hey, I was wrong, so I own it. Got that one wrong. Now, we talked about a lot of other stuff. I'm not going to rehash the entire show from last year. Let's get to the important prediction, which is our area of expertise, and that is what would happen to insolvencies in 2022. So here is my prediction from last year's show. Let's play the clip. My prediction is that by October of 2022, which will be the numbers we will have access to if we do this podcast in a year, I think personal insolvencies will be 20% higher than they were in October 2021.
Right.
So I predicted a 20% increase. And what actually happened? Well, in October 2021, there were 2,567 consumer insolvencies filed in Ontario. October 22, there were 3,019 for an increase of 17.6%. I round that off to 20%. I nailed it perfectly.
I think you got that one. That's good.
Now, let's play your prediction. See what you said. So here we go. Final clip from last year's show. October 2022, what do you think the change will be compared to October 2021?
Well,
I'll just sip my coffee while Ted thinks.
Yeah, I know. You're saying 20%, and that's if the government gets back to work in the summer, that 20% will be low. I don't think the government's going to get back to work in the summer anymore. So I think the union will keep them out.
So you're assuming less than a 20% increase. Yeah. You predicted that government workers, such as CRA, would not be back in the office in 2022. Turns out you were right. And as a result, they wouldn't be able to aggressively start collecting back taxes. So as a result, insolvencies would go up less than my prediction of 20%. And you were correct. October was an increase of 18%. So you were right about inflation, and we were both pretty accurate on our insolvency predictions. But you were closest to the pin. This was a golf game, so you win. Okay, now.
I guess that means people should listen to the show, though, because
exactly.
we were pretty good.
Yeah, I think we did it pretty well. And, I guess in hindsight, you are more cynical than I in that.
Yeah, that's a safe statement.
And I'm pretty cynical. But you were of the view that, hey, there's no way the government's getting back into the office any sooner than they have to. And, of course, as we record this in December, they have announced that, okay, you're going to have to start coming back to the office a couple days a week in, March or April or whatever.
April. They had to give them 90 days notice.
So that, I think, will mean there will be more people working at CRA who can then be sending out papers to be collecting. And so we'll see a change next year. So Let's get to the predictions for 2023. But again, it's the thought process that's more important than the prediction. So what we're going to do is look at some numbers so that everyone watching can play along and make your own predictions. So first data point, the cost of living is increasing faster than wage growth. Everybody knows that.
Right.
So I already said the consumer price index was up 6.9% in October 2022, while employees saw their hourly wages increase by less than that, about 5.6% year over year, same period.
So you're losing money just by staying in the game.
There you go. And that's exactly the point. And we'll put the charts up here. Food costs increased 10.1% year over year in October and are expected to rise another 5 to 7% in 2023.
Right.
The vast majority of our clients in 2022 are renters. They don't own a house, and we'll talk about real estate in a bit. And rents continue to surge. According to rentals.ca, rents rose 11.8% in October 2022.
Sorry, and how much was the wage increase last year?
5.6%.
So rent is doubling the rate of increase.
Right. And food costs pretty close to doubling as well. Now, obviously, food and rent are not the only thing you spend money on, but they're a pretty big component of it.
That's exactly right. Well, I mean, rent is probably somewhere between 30 and 40%. Food is probably between 10 and 20%.
Well,
so
and for some people,
that's more than half your pay.
Yeah, for some people, their rent is 3/4 of their pay. I mean, it's very common, certainly in places like Toronto. So, okay, my expenses are going up faster than my income. What do? Well, the first thing I would do, if I have any, is I'll tap into my savings.
Right.
So let's take a look at the household savings rate, shall we? And we've taken a look at this before on this show. The household savings rate, which is the amount of money you save, if you want the technical definition, you take your personal disposable income, you subtract whatever you spend on stuff, and whatever's left over is your savings. So over the last, 20, 30 years, the savings rate has been dropping. And so prior to the pandemic, it was pretty close to Zippo.
Nothing.
We had no savings. And then the pandemic hit, and all of a sudden the savings rate spiked way up. And we've talked about that on the show before. Why did it spike way up, Ted?
Yeah. People weren't able to spend money. They were locked in their homes, and there was relief on certain types of debt. So a number of factors combined to basically say you're able to put some money aside. And usually people do that when they're afraid for the future too. So that just compounded it.
That's right. Those two factors. And so by the second quarter of 2020, so right at the height of the pandemic, the savings rate, which had been 0 back in 2018, was up to 27%, a massive number. But it's been falling ever since then. Second quarter of this year, 2022, 5.1%. Third quarter, it actually spiked back up to 5.7%, which is really bizarre to me.
Figure that there's something strange going on there.
I don't know why that is, although it could be what you just said. People are worried about the future, so I better hold a little bit back.
Yeah, we're all expecting a recession. I mean, some of us think we're already in one. And so, yes, when you think things are going to get bad, you stop spending money.
I am of the view that we are in a recession, but if you want my prediction, I don't know if it's part of our script here, but my prediction
We'll do it later.
Well, my prediction is that the recession will be officially declared probably in March or April of 2023.
Yeah, we've got to have a quarter of shrinkage, don't we?
Well, we had 2 quarters of reduced of negative GDP growth, but they didn't declare a recession because they said, well, wait a minute, the unemployment rate is still really low. How can we be in a recession if everyone has a job? So it all depends on your definition of a recession. I'm of the view that it'll be quite obvious by the time we get to the spring. Okay, so my expenses are higher than my income. So what do? I deplete my savings. Once my savings are depleted, what's the next thing I do? I turn to debt.
You got no choice. The cash has got to come from someplace.
So credit cards, that's the easiest kind of debt to get because I've probably already got one in my wallet. So in February of 2021, credit card debt fell to a 10-year low. Again, we'll put the chart of this up for the reasons you just talked about. It's been a year into the pandemic, don't have anything to spend money on. I might as well pay down my credit cards because I've got the cash. But, and I can't remember if you predicted this last year or not, but credit card debt is now not only back to where it was, but higher than it's ever been before.
I'm pretty sure I predicted that one because I remember clearly thinking that going into the pandemic, things were bad. We were hitting new records, and coming out of it, they were going to be worse.
And so if we do this podcast 3 years from now and look at this same credit card debt chart, there will be a big drop during the pandemic, but the overall trend line probably just keeps on going. So if this was a stock, I guess you'd be buying. And there are 3 reasons that credit card debt has gone up. The first one is the obvious one. Well, with inflation, my expenses are higher. I'm using credit cards to survive. The second one is that consumers are looking for more credit capacity. So if I've got 2 credit cards and one of them is maxed out, or they're both maxed out, what do? Well, I get a third credit card.
Right.
And we know that new credit originations were up 35% in the third quarter of 2022, according to TransUnion. That's a massive number.
Huge. Yep. And it's just a warning for the future. Things are going to get much worse.
Exactly. And then the third thing is, well, I just can't make the full payments on my credit card. So I'm not paying them off in full every month. Maybe I'm paying just the minimum. Maybe I'm not even to pay that. So Equifax reported that the average payment rates for those who carry a balance are lower than 12 months earlier. Not too surprising. Okay, credit cards are one kind of debt. Let's throw up the chart of the next kind of debt, which is lines of credit. So on this chart, maybe you got to squint to see it if you're watching this podcast on your phone, but we've got the blue line, which is HELOCs, and the orange line, which is non-HELOC. So Ted, explain what a HELOC is.
So it's a home equity line of credit. It means they've taken the value of your home and they've extended credit to you based on how much equity is available to them if the house was sold. Those numbers have probably all changed recently, but at this point, they haven't started clawing back on HELOC balances. Right? It
is starting now because you're right. A HELOC is secured by my home, and the bank says, okay, fine, we'll give you a HELOC up to 50%, 80%, whatever it is of the value.
Whatever
of
the
home.
number is. Yep. Probably 80% is the max.
And if your home value is going down, guess what? You're going to be able to borrow less on a HELOC. And so HELOCs grew considerably in 2021 up into 2022 because, hey, house prices are going up and I need the cash. But recently it is the non-home equity lines of credit that are the ones that are increasing the fastest.
Well, and you're a pretty strong believer that the housing market, it's been inflated for years, right? We're expecting a much bigger correction than anybody's experienced so far.
Yeah, and obviously we're not experts in real estate, but that would be the short answer. So our non mortgage lines of credit have gone up. They're now back to where they were before 2020. We're still not quite at the peak of where they were back in the middle of the last decade, but we're certainly heading in that direction.
We will be by the summer.
It's
because people turn to their lines of credit to pay off their credit cards, and then they run their credit cards up again.
It certainly appears to be heading in that direction. Now, the next chart is kind of interesting, and hopefully you can explain it to me because it's a little bit bizarre. So historically, and again, we'll put this chart up. We've got a chart that shows the growth in consumer insolvencies. It's a 12-month rolling average just to smooth it out, and the change in the unemployment rate. Again, 12-month rolling average to smooth it out. So when you look at the chart, the lines move together. Unemployment goes up, insolvencies go up. They go down, they go down. But then we had this huge decoupling when the pandemic happened. Unemployment went way up. Okay, well, that's pretty obvious. People weren't working.
Right.
And consumer insolvencies went down. And we've talked about that many times on the show. Why is it that consumer insolvencies collapsed?
So I'm convinced that the consumers' insolvencies collapsed because the number of folks chasing people dropped dramatically during the pandemic. You go back to March of 2020, and the instructions from the tax department were leave people alone. The courts were shut down, so there was no activity going on from a legal standpoint. And the folks we saw that were still filing an insolvency, a consumer proposal or a bankruptcy, were the ones that recognized themselves that, hey, I've got a problem, and this is a good time to deal with it. More than half the people that end up filing an insolvency, it's because somebody's pushed them into doing it. They know they have a problem, but until somebody pushes them, they won't take the corrective steps to fix it.
So it made sense that unemployment was going up, but insolvencies were going down, something that virtually never happens. However, when you take a real close look at this chart, we can see that even before the pandemic, there was a change in this pattern. In 2018, the unemployment rate in Canada fell by 8% because, things were good, but insolvencies increased by 2.5%. In 2019, the year before the pandemic, we saw consumer insolvencies increase by almost 10% per year, while unemployment fell another 2.9%. So why do you think it is that consumer insolvencies were rising so rapidly before the pandemic despite low unemployment?
Well, because before the pandemic, we were getting to historic levels of debt and all sorts of consumer credit. So the credit card balances were the highest they'd ever been. Even the lines of credit, while they weren't at record levels, they were still very high. And so the folks that had jobs were still getting to the point where they couldn't afford to service the debt that they had.
Right. And so consumer insolvencies are based on many different factors. It's not just one thing. Unemployment is certainly a factor. Debt is certainly a huge factor. The carrying costs of debt, certainly a huge factor as well. And of course, interest rates have gone way up. So that's why we've got this splitting out, this and
all the effects are
decoupling.
Cumulative, right? So we know that pre-pandemic, well, the interest rates have been historically low for an extended period of time. So people could afford to carry more debt, or at least they thought to. But at some point, even at a low interest rate, you're carrying so much debt that you can't make the monthly payments. You got to deal with them.
Now, let's talk about the other elephant in the room, which is real estate. So, as you know, we published the Hoyes Michalos Homeowners Bankruptcy Index, which is named after Hoyes and Michalos, because
who are those guys?
We got pretty big egos, so we've got our own index. And what it shows is the percentage of our clients who file a proposal or bankruptcy who own a home at the time they file. And as everyone who watches this show knows, back in 2011, the index peaked at around a third, meaning a third of our clients owned a home at the time they filed. But that wasn't a big problem. Why? It's not like we were taking everybody's home back then.
Yeah, they didn't have excessive levels of equity, so they're still able to maintain their home.
Right.
So in a personal insolvency, we're dealing with your unsecured debts, credit cards, lines of credit, payday loans, if you have any. As long as you're able to maintain your mortgage payments and there's no net equity accumulated in your home, it doesn't become a factor in an insolvency.
Yeah, so back in 2011, more than a decade ago, somebody might have come in to see us and they own a house that's worth $300,000 and the mortgage was $280,000. Okay, by the time we sold the house and paid the real estate commissions and the penalties to break the mortgage and everything, there'd be very little equity there. So maybe there was $10,000 worth of equity. They'd do a proposal. They'd offer their creditors a little more than $10,000. Everyone was happy. Correct. But of course, in 2021, when someone came in to see you, they owned a house worth $1 million and the mortgage was $500,000 because it had gone up so much in the last couple of years. So there's so much equity. Well, you're not going to go bankrupt on $50,000 worth of debt if it means you're going to lose a house with $500,000 in equity, which is why for the first time ever in history, in August of 2022, the Hoyes and Michalos Homeowners Bankruptcy Index hit a record low of 0. Nothing. And I actually went through and checked the data because I didn't believe it. I went through every single file we did in August to make sure, and sure enough, not one single person owned a home that month.
Right.
Now, since then, the index has bounced back to 2.6%, which is still really low historically, but we can see which way the trend is going. So what do you expect this chart to look like in the future? And the chart we've put up on the screen is the Hoyes and Michalos Homeowners Bankruptcy Index, which has been going down since 2011. And we've also put up the House Price Index, published by Teranet and National Bank, which has shown, of course, that house prices have been going up. So what do you think this is going to look like in 2023?
So I think there's more of a correction coming for the house prices, at least in the major markets, which means that the number of folks filing an insolvency, it's going to go up, the ones that own homes. I think it would be interesting to try to guess over time, historically. So when interest rates were traditionally at 4 and 5%, which is what they were at throughout the 70s and in the 80s, they were pretty ridiculous too. 70s, 90s, and the first part of the 21st century. We'll be looking at the same kind of default rates and mortgages as we did during those stable times. Everybody's forgotten. We had low interest for so long that mortgage at 2.5%. Well, that's normal. Well, it's not. It was never normal. A mortgage at 5% is probably normal, which is where we're at now. It's going to correct beyond that 6 and 7% before we get through this recession.
Yeah, and I would argue that a normal mortgage rate is something like 1, 2, 3% above the rate of inflation. Okay. So if inflation is running 7 or 8% and mortgage rates are running 5%, then I would say they're still too low based on history, or the inflation rate is going to come down a lot. Now, there's one other data point that I didn't put in here, but since you're a car guy, I will throw it out there. And this is more U.S. based. I haven't seen the data in Canada, but we all know that used car prices went way up during the pandemic, supply chain shortages, the whole bit. Now they have started to correct. They're coming back down. There's more supply. Fewer people are out there buying cars because, of course, interest rates are higher. So what's been happening in the U.S. is normally if you go to buy a car, the dealer says, okay, no problem, we can finance it, but you're going to have to pay off your old car first. We're going to sell it, roll it in, whatever. And that, of course, makes it a lot more expensive to buy the new car. So apparently it has become a thing in the U.S. that the lenders are saying, you know what, we're okay if you've still got that previous vehicle. We're going to just sell you the new one. Don't worry about rolling the shortfall from the old one in. Why would they do that? Well, it's because they assume then you will be defaulting on the old car, but not on the new one. Right. And that seems to be becoming a bigger and bigger thing in the U.S. at the moment. Now, I don't know if that's going to hit us here in Canada or not, but that sounds pretty scary to me.
And the Canadian finance companies have always been better at financing the shortfalls in your next car. So you got to remember the car prices in the U.S. are somewhere 20 to 30% lower than they are in Canada just because of sheer volumes. So a car payment generally and the amount of debt you're incurring for a car is lower. In Canada, it's almost always been the case that if you go in for a new car, within the first 3 years of owning or financed another one, there's going to be a shortfall that you're rolling forward. And that's how a lot of our clients get in trouble. Car's not a luxury item. It's a necessity for most people. You got to get to work somehow. Transit works sort of, but not for everybody. You still got family and grocery commitments. So cars are a priority. Having a car that's dependable is also a priority. So you get 3 years into your payment plan, things start to go wrong, the warranty's worn out, and you go, well, okay, I need to flip this. And dealers are all quite happy to flip it, to add that, $3,000 to $5,000 worth of debt to your new loan, because they make more money off the financing than they do off the cars.
But what happens if 3 years ago I bought a car for $40,000, and let's say it was even a year or two ago right at the peak, so I paid $50,000 for the car. And now today, 3 years later, because of the drop in prices, that car is only worth $20,000. So there's a much bigger shortfall. Well, now I'm going to go buy a $40,000 car. Kind of hard to roll a $30,000 shortfall into a $40,000 car.
Yeah, people with that kind of difference won't be able to do it.
Right.
There'll be problems.
And
but we'll see them getting the new vehicle, which has always happened with insolvencies, and then filing a consumer proposal or bankruptcy to deal with the old one.
Yep. And so that may become a much bigger thing in 2023. Okay, so prediction time. Here we go. That's why everyone is tuning in, right? So I'm going to give you my big picture assumptions on all this, and then you can chime in with whatever you want to say. So my first assumption, which I was completely wrong on last year, but my assumption is that inflation has peaked. That's my assumption. And again, I know I was wrong, but I'm going to repeat my prediction that inflation will be lower next year than it is this year. It's just under 7% now. I'm thinking, 2, 3, 4% by this period next year. So I think inflation has peaked. And for a lot of the reasons we've just talked about, prices have gone up so much, I can't be buying as much stuff. Well, if people are buying less stuff, that ultimately leads to lower prices. And for all the economists watching, I know what I just said didn't make any sense, but that's kind of conceptually how it works. Well, obviously there's inflation caused by supply issues, and then inflation caused on the demand side. So with all the supply chain issues we've had over the last couple of years, that's driven up costs. If those supply chain issues get fixed, then that certainly brings down prices. The other thing that causes inflation, probably the main thing, is how much is the government spending? Well, I don't think they're going to be running $400 billion deficits every year for the foreseeable future like they did during the pandemic.
When's the next election?
Yeah, exactly right. Well, I guess it could be any time because we have a quasi-minority government, but it's probably a year or two out.
So I'm thinking that there's still room for inflation to go up a little bit. I don't know that it'll go up in January or February, but by this summer, because of some large collective bargaining agreements with, public employees, I think inflation is going to go up a little more, and maybe by next Christmas we're back at that 5% level again. I like that 5% number.
There you go. So your prediction for 2023, by the time we do this podcast next year, we're back down to a 5% inflation level, and I'm thinking it's lower than that, 3 or 4%. Right. Now, my second big picture assumption is that interest rates are close to peaking. And I think on the long end, they've already peaked, 5-year, 10-year bond yields, whatever. I think the Bank of Canada and the Fed may raise rates 1 or 2 more times early in 2023, but it's obvious to me that we're in a recession. So at some point in 2023, they're going to have to stop raising and then, in other words, hold steady. And then I think by the end of the year, they will have had to start lowering them. So, and, the markets agree with me. If you look at the 2-year government bond yield, and I looked at this a couple of days ago, so don't quote me on the numbers, but it was around 3.7%, and the 10-year bond yield was around 2.8%. That's almost a full percentage point difference between the short and the long end, which makes no sense at all. So that's the old inverted yield curve that you hear about on the news all the time. Why would I be willing to accept less money for something I'm borrowing 10 years in the future than what I'm borrowing now? If I got to wait that long, I want to be compensated for the risk. Well, the reason is because the market, investors believe interest rates are coming down. So 10 years from now, they'll be lower than what they're going to be 2 years from now. So, and I think it also factors into what you said earlier. People are worried about a recession. I want my money to be safe. So I'm certainly not going out and aggressively borrowing when interest rates are higher. Supply and demand kind of drives interest rates down as well. So I'm of the view that a recession is already here, but it will be declared officially in the spring of 2023.
Right.
What are your thoughts on interest rates?
So again, I'm thinking that we've got at least one more round of increases in January, and then we hold steady probably all the way to the summer, and it depends on what the world looks like. But from a historical perspective, I think mortgages should end up next year at 5%, which is about where they're at right now. So that means the prime rate will be what, 3.5 or 3 3/4?
Yeah, I mean, I'm predicting lower next year than it is this year, and I guess you're kind of saying the same thing. You're right.
I'm just not as low.
Just not as low. Okay. And it's really hard to figure out the quantum because, okay, what else is going to happen next year? We don't know, but that's kind of the direction I think it's going in. I also believe that unemployment is going to get a lot worse than what it is now.
Well, how does the unemployment rate factor in the people that have just given up on the system?
Well,
or the gig workers that aren't part of all this stuff, right?
Yeah, so the labor force participation rate has been coming down for years. So there are people who just drop out of the labor force. They're not counted in the unemployment statistics because they're not looking for a job.
So I think the labor force participation rate then is going to continue to drop, and I don't know that that's going to have as much of an impact on the unemployment rate because we're already predicting that that certain types of professions you can't get enough people to do the job. So it's
at the moment.
Right.
And so does that change? Well, again, if people are buying less stuff because of inflation, I can't be doing stuff I was doing. I think that reduces the demand.
Isn't the government saying, though, that they're going to increase the immigration rate to 500,000 people a year because they're anticipating all of this drop?
Well,
like they're going to have a worker shortage?
Yeah, the immigration rate is already at 500,000. It's just they come in as temporary. They're going to school, they're on work visas, whatever, and then they officially make it official. Well, they're already here. But yes, you're right. Their target is to bring in 500,000 new people every year. And so if you have that much greater supply of labor, how does that make the unemployment rate go down?
Right.
Doesn't that make it go up because there's more people there? And
except for it's offset by the participation rate, which is declining.
Yeah. So, kind of hard to look at all the different factors and figure out exactly what's going to happen. But again, my prediction is unemployment will be a lot higher at this time next year than it is now. So the final prediction, the only one that really matters, what do you think will happen with personal insolvencies in 2023? So I'll give you my prediction first because I'm never right, and then you can tell us what the correct number is. So my prediction is that October 2023, which will be the last numbers we'll have access to when we do this podcast next year, as compared to October of 2022, which is the most recent numbers we have as we're recording this, consumer insolvencies in Ontario will be 30% higher than what they are today. So last year I predicted 20%, and they ended up being just under 18%. Next year I'm predicting 30%. What's your number?
So at 2022, we're back to what? 2010 or 28 levels of insolvencies? Historic numbers?
We're back to sort of 2017, 2018 numbers. We are not back to where we were prior to the pandemic, and we certainly aren't back to where we were in 2008, 2009.
Yeah. So I think in April, when the federal employees go back to work for 2 or 3 days, the government will announce that by Labor Day, they've got to go back to work for 4 days a week. And then October, 30%. Sure. I think we're going to be back to pre-pandemic levels. So 2019. And is that going to be at 30%? I don't remember the numbers.
Well, it probably is something in that range. It depends where this year finishes up, obviously. And I don't even know if 30% gets us back to the peak of 2019. What's more amazing about that, if you look at, I know October of 2022 was about the same insolvency level number as 21 years earlier.
Right. Yeah, I remember you sharing that stat.
Which is completely bizarre because I'm pretty sure the population of Ontario is higher than it was 21 years ago.
Well, and the total levels of debt is probably exponentially higher.
Right. And I believe the population of Ontario is 25% higher. Debt levels are easily double, and yet the insolvency rate is exactly the same. Well, that means on a per capita basis, it's way lower. So there's certainly a huge amount of room to catch up. But the wild card is how many people just drop out of the workforce and say, forget it, sue me. I don't care. You can't come after me. So, okay. So we're both coming in at around that 30% level.
Pretty high number.
A pretty high number. So final question for you then. What does that mean for the people watching then? What should I be doing to prepare myself for 2023?
Yeah, so the irony of all this is if you do what's smartest for you as your family, which is cut back on your spending, increase your savings, you just accelerate the whole process of the recession and you make it deeper. And so doing what's right for you is not doing what's right for the rest of us.
Yeah, I guess if I'm the prime minister, I want you to take on as much debt as you can, spend as much money as you can, get the economy going so that everything.
I want you to stay active. That's right. I want you to keep spending every dollar you make because of the multiplier effect. But if I'm looking after my own family and I'm thinking, Jesus, by the summer I may not have a job, I'm going to stop spending altogether. And then it becomes a self-fulfilling prophecy. Yeah,
and obviously we are here to advise the individual person, not the government of Canada. They don't call me, so I don't give them any advice. And again, we're not here to advise anyone. We're just telling you what we think our thought process is. But yes, if it's me, I'm saying to myself, okay, things are going to get worse next year in terms of the economy. I think we're going to be in a recession. So I probably don't get as much hours at work. I might not get the overtime. I might get laid off. Interest rates are going up, so whatever debt I have is going to cost more. So the obvious answer is I want to have as little debt as possible, pay that debt down, have some savings. If I can do anything to increase my income, well, maybe next year is the time to get a part-time job, something like that. That's probably the best way to prepare.
Well, and there's some psychology to this too, folks, that maybe you want to consider, in that we're all going to be in the same boat with the recession and things getting hard again. So it's a little easier to convince yourself that you should be talking to somebody like you and I about sorting out your finances. You know, it's counterintuitive. Everybody thinks when the world slows down, the insolvencies go way up, but it's actually when things pick up again that they get really high, because there's no point trying to pursue somebody in the courts if they haven't got a job, they haven't got a paycheck. But that may be the best time for you to actually sort out your finances. When things are starting to get tight, do it before things get bad, because then you can position yourself to be in a better shape as you come out of it in the fall.
Yeah, I totally agree. Being proactive is a lot better than waiting till my wages are being garnished to do something. So if you are having debt problems, obviously go to Hoyes.com and you can...
And don't turn to installment loans. Don't turn to payday loans. If you can't get a loan at the bank, then give us a call. We'll tell you how to solve the problem. Don't make these bastards any richer than they are.
I deliberately left payday loans out of this because I could have thrown also. I thought I would
put it in somewhere.
Let you be calm. So there you go. That is the wrap up of 2022 and our predictions for 2023. Ted, thank you very much for being here virtually. We will see how we did a year from now. That is our show for today. Thanks for listening throughout the year. Remember that a new show comes out every Saturday morning, so subscribe on YouTube. All the show notes will be there showing all the graphs and charts we put up on the screen today if you want to do a deep dive for yourself. And again, if you're listening to the audio version, same thing. Subscribe so that you get notified of each new episode every Saturday morning. That is our show for today. Happy New Year. Please like and subscribe. Until next week, I'm Doug Hoyes. That was Debt Free in 30.